September 15th, 2008. The world was still asleep, ... But Wall Street was not breathing. The glass tower that bore the 158-year history of Lehman Brothers was silent as a tomb that night. Inside, hundreds of employees sat at their desks, staring at blank screens. Computers were on, but hope was gone. Hours earlier, CEO Richard Fuld had walked out of the longest meeting of his life. There were only two things on his face: anger and despair. There was no salvation now. In just a few hours, Lehman Brothers, America's most prestigious investment bank, would announce the biggest bankruptcy in history, a $600 billion bankruptcy, and the repercussions would devastate millions of lives around the world. That night, the lights stayed on Wall Street, but the city was no longer the same. Asterisk, 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 translated with www.deepl.com/translator. Free version. Asterisk, 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 before it became a name whispered in the corridors of power. Before it was stamped on skyscrapers and billion-dollar deals. Lehman Brothers was just three immigrants in a new land, chasing survival. 1850, the cotton merchants. The story begins in Montgomery, Alabama, in 1850. Henry Lehman, a young man from Rimper, Bavaria, stepped off a ship onto American soil with nothing but a few coins in his pocket and a determination forged by hardship. Like many immigrants of the era, he carried not just luggage, but a vision of freedom, prosperity, and a place in the growing American dream. Henry opened a small dry goods store, selling everyday necessities to farmers and locals. But Henry wasn't blind to the patterns of trade around him. Alabama wasn't just another state. It was the beating heart of America's cotton economy, the white gold that fueled both domestic mills and European markets. Cotton wasn't just fabric, it was wealth and power. When Henry's brothers, Emmanuel and Meyer, joined him. In the following years, they expanded the store into something more ambitious. They began accepting raw cotton from farmers as payment for goods, quickly realizing that the commodity itself was more valuable than the cash it replaced. The brothers didn't just sell goods anymore. They traded in cotton, the lifeblood of the Southern economy. Soon, the Lehman store transformed into a cotton brokerage. They were no longer shopkeepers. They were deal makers. War, fire, and survival. But prosperity in the South was tied to a dark truth: slavery. Cotton's booming success came at an unthinkable human cost. As tensions between North and South escalated toward the Civil War, the Lehman Brothers were caught in a storm that threatened to destroy everything they'd built. When war erupted in 1861, trade routes collapsed. The cotton market imploded. Montgomery was no longer safe. The Lehman Brothers relocated their business to New York City, the emerging financial hub of America. There they could connect Southern cotton producers with the capital-rich merchants and industrialists of the North. But in New York, the game was different. It wasn't about owning the cotton. It was about financing the trade. They began providing loans, facilitating deals, and connecting investors. Their reputation for reliability and their willingness to take calculated risks set them apart. In 1887, Lehman Brothers officially joined the New York Stock Exchange, planting its flag in the very center of America's financial future. From cotton to capital, by the turn of the century, Lehman Brothers was no longer defined by the cotton fields of Alabama. It had evolved into a diversified investment bank, financing everything from railroads to retail companies. They were there in the early days of General Electric. They backed Macy's department store expansion. They provided the capital for industries that would define the American way of life. Through the Roaring '20s, Lehman Brothers thrived, underwriting bonds and fueling the economic boom. But they also survived the 1929 stock market crash, a feat that wiped out many of their competitors. How? Conservative management, cautious leverage, and a focus on long-term investments rather than reckless speculation. In the post-war boom of the 1950s and 60s, Lehman Brothers became synonymous with innovation in finance. They took companies public, navigated mergers, and mastered the subtle art of corporate relationships. In Wall Street's inner circle, Lehman wasn't just another bank. It was a club of insiders. The 1980s, greed wears a suit, but by the 1980s, Wall Street was changing. The era of pinstripe deals over cigars was giving way to the age of high-octane capitalism. Junk bonds, leveraged buyouts, and aggressive corporate raiders dominated the headlines. Inside Lehman Brothers, old-school conservatism clashed with a new hunger for fast profits. The firm was known for its prestigious name, but it lacked the cutthroat, profit-obsessed culture of rising competitors like Salomon Brothers or Drexel Burnham Lambert. Pressure mounted. Leadership disputes erupted. In 1984, American Express acquired Lehman Brothers, merging it with Shearson to create Shearson-Lehman American Express. For a while, the Lehman name was diluted, a respected legacy bank hidden inside a corporate giant. But the merger was an uneasy marriage. The culture clash between button-down bankers and aggressive traders was impossible to ignore. By the early 1990s, American Express decided to spin off Lehman Brothers once again, setting the stage for a new era, one that would define both its greatest success and its ultimate downfall. They had survived war. They had survived depressions. They had survived the corporate sharks of the 1980s. But the storm coming for them was unlike anything they'd ever faced. When Lehman Brothers returned to independence in 1994, it was like a soldier discharged from a long war, older, wiser, but carrying scars. On paper, the spin-off from American Express was a rebirth. In reality, it was a re-entry into a financial world that had changed beyond recognition. A new game on Wall Street. The 1990s weren't just a boom decade. They were a transformation. The Cold War was over. Technology was exploding. The internet was no longer science fiction. It was an investment opportunity. And global capital moved faster than anyone could track. Wall Street banks weren't just financiers anymore. They were empires, diversifying into asset management, proprietary trading, and most dangerously, the engineering of complex financial products few truly understood. Lehman's leadership knew they had to evolve or die. Richard "Dick" Fuld, who had joined the firm in 1969 as a commercial paper trader, was now at the helm. Fuld was charismatic in a cold, intimidating way, a CEO who could inspire loyalty but also strike fear. His nickname inside the firm was the Gorilla, not because of brute stupidity, but because once he got his grip on something, he wouldn't let go. Fuld's vision: Lehman would no longer just advise deals. It would own them. It would no longer just broker trades. It would create the products to be traded, and it would no longer settle for a respectable place in the middle of Wall Street's food chain. Lehman would be at the top. The rise of the mortgage machine. The 1990s real estate market was heating up. Home ownership was the American dream, and banks had discovered a way to profit not just from lending money, but from selling the loans themselves. This is where the modern mortgage-backed security, the MBS, became Lehman's golden ticket. And MBS was simple in theory. A bank loans money to a homeowner. Instead of waiting 30 years to be repaid, the bank sells the loan to an investment firm like Lehman. Lehman bundles thousands of these loans into a single package and sells slices of that package to investors around the world. It was marketed as a safe, income-generating product. After all, people always paid their mortgages, right? Lehman became one of the most aggressive players in this market. They weren't just buying loans from big banks. They were buying from smaller mortgage originators who specialized in lending to non-traditional borrowers, people with poor credit, inconsistent income, or little documentation. In finance speak, these were called subprime mortgages. In human terms, they were high-risk loans to people who could barely afford them. Com. Euphoria while mortgage became Lehman's long-term play. The short-term feeding frenzy was in tech stocks. The late 1990s dot-com boom was an age where a company could go public without profits, sometimes without even a real product, and still make millions overnight. Lehman jumped headfirst into this gold rush, underwriting IPOs for internet companies at a dizzying pace. Every successful IPO meant huge fees for the bank. But like everyone else, they ignored one glaring question. What happens when these companies fail? By 2000, that question was answered. The dot-com bubble burst. NASDAQ crashed nearly 80% from its peak. Fortunes evaporated in months. Wall Street's love affair with easy tech money came to a brutal end. For Lehman, the dot-com crash was a wake-up call, but not in the way you'd think. Instead of becoming cautious, the bank doubled down on the one market that seemed immune to tech's implosion. Housing. Housing, the safe asset that wasn't. 2000 saw interest rates drop to historic lows. After the dot-com collapse and the shock of 9/11s, the Federal Reserve slashed rates to keep the economy alive. Low rates meant cheap mortgages. Cheap mortgages meant more buyers. More buyers meant higher prices. Higher prices meant the illusion of endless growth. Lehman wasn't just riding this wave, it was building the surfboard. They became a dominant force in mortgage securitization, turning risky home loans into shiny financial products stamped with AA, ratings from credit agencies. Investors, from pension funds to foreign governments, couldn't get enough. The scenes, Lehman began to take on more leverage, borrowing enormous sums to fund its investments. In 2003, the firm's leverage ratio was already well above 20-1. This meant for every $1 of actual capital, Lehman controlled more than $20 in assets. A small drop in asset value could wipe out the firm's equity entirely. The culture shift inside Lehman's Manhattan headquarters. A new culture was taking root. Aggressive young traders replaced conservative old-school bankers. Bonuses were tied to short-term profits, not long-term stability. Risk managers, the people whose job it was to say no, found themselves sidelined or ignored. Folds. Leadership style was absolute. Dissent was not tolerated. Loyalty was everything. Employees who questioned strategy were often pushed out, while those who delivered profits, no matter how, were rewarded handsomely. Lehman had survived over a century of wars, depressions, and financial shocks. But now, it was quietly laying the foundation for a catastrophe, one built on the belief that housing prices could never fall, and that Wall Street could always outrun risk. In chasing the dream of endless growth, Lehman Brothers forgot the first rule of survival: nothing grows forever. The early 2000s were a strange time on Wall Street. The dot-com wreckage still smoldered. The scars of 9/11s were fresh. And yet, in the suburbs of America, a new gold rush had begun. It wasn't in oil, or tech, or manufacturing. It was in mortgages. And Lehman Brothers wanted every ounce of it. The housing boom turns to mania. Between 2003 and 2006, U.S. home prices soared at rates unseen in modern history. The narrative was intoxicating. Real estate always goes up. They're not making more land. It's the safest investment you can make. For Wall Street, this wasn't just a housing boom. It was a money-printing machine. And Lehman Brothers wasn't just playing the game. They were building the game board. From Wall Street to Main Street, Lehman didn't make most of its mortgage directly. Instead, It bought loans in bulk from mortgage originators, companies like Countrywide, Fremont, and New Century. These firms specialized in giving loans to almost anyone who applied. Credit score too low? No problem. No proof of income? Sign here. Can't afford the payments? Don't worry. They'd give you a teaser rate for the first 2 years. The logic was simple. Housing prices are rising so fast, even if a borrower defaults, the home can be sold at a profit. Lehman's role was to gather thousands of these risky loans, package them into mortgage-backed securities, MBS, and sell them to investors hungry for safe returns. The magic trick? The credit rating agencies, Moody's, S&P, Fitch, stamped many of these securities with the AA ratings, the same as U.S. government bonds. In other words, toxic loans disguised as gold. The birth of the CDO monster, the MBS market, was just the start. Lehman, like its competitors, found ways to slice and repackage these securities into even more complex products called collateralized debt obligations, CDOs. Imagine a Russian nesting doll made of debt. Inside each CDO were slices of mortgage securities. Inside those securities were hundreds or thousands of individual home loans, and many of those loans were given to borrowers who could never realistically repay. The complexity was deliberate. It allowed Wall Street to sell high-risk assets to investors who thought they were buying something safe. Lehman wasn't just selling these CDOs. They were keeping large amounts of them on their own balance sheet. The profits were, too, good to resist. Leverage like never before. Lehman's leverage ratio, the amount it borrowed compared to its equity, exploded. By 2006, it was around 30-1. That meant a mere 3% drop in the value of its assets could wipe out the firm's entire capital base. Fold and his lieutenants weren't blind to this risk. But in the fever of the subprime gold rush, risk didn't feel real. Housing prices had never fallen nationwide in modern history. To most on Wall Street, that was proof enough it could never happen. Inside Lehman, the culture of the boom, the trading floors at Lehman were electric. Bonuses were hitting record highs. Young traders drove new Porsches and Ferraris. Luxury vacations were booked without a second thought. The firm rewarded the most aggressive risk takers, the ones who could push billions in mortgage securities. Out the door. Risk managers who raised alarms found themselves shut out of meetings. Those who played along rose quickly. Lehman's headquarters at 745 7th Avenue gleamed with confidence. It wasn't just a building. It was a monument to their dominance. Inside, screens flashed green as mortgage profits rolled in. The shadow warnings, not everyone was convinced. The boom would last. A handful of analysts and economists began worrying about the growing subprime exposure. They pointed out that many loans were ninja loans. No income, no job, no assets, handed to borrowers who could barely make the teaser rate payments, let alone the higher ones after 2 years. If housing prices stopped rising, the whole system could collapse. But inside Lehman, the mood was dismissive. Bears had been wrong for years. Housing kept going up, and every quarter, the profits were bigger than the last. The illusion solidifies. By 2006, Lehman Brothers reported record profits of $4.2 billion. They were the top underwriter of mortgage-backed securities in the United States, having issued more than $146 billion worth in a single year. Richard Fuld was celebrated as one of the most powerful men on Wall Street. The financial press called Lehman unstoppable. The stock price climbed relentlessly, hitting all-time highs. But beneath the surface, the machine was overheating. The firm was loaded with toxic assets, hidden behind layers of financial engineering. Its leverage made it fragile. And the borrowers behind those AA-rated securities? Many were already struggling. The gold rush had blinded everyone to the cliff. Ahead, They thought they'd found a new law of finance, one where risk didn't matter. But the laws of gravity still applied. And gravity was about to take hold. By the summer of 2006, the American housing market looked invincible. Prices were at record highs. Builders couldn't pour concrete fast enough. Mortgage brokers worked 7 days a week, signing clients over coffee tables and in fast food parking lots. On paper, Lehman Brothers was on top of the world. In reality, hairline fractures had begun to spread through the foundation. The peak. Nobody recognized housing bubbles. Don't announce their arrival. They don't ring a bell at the top. But by mid-2006, something subtle had shifted. In overheated markets like Las Vegas, Miami, and Phoenix, home prices weren't just leveling off. They were stalling. Inventory was building. Houses that once sold in hours now sat for weeks. In some neighborhoods, investors who'd bought 3 or 4 properties began quietly trying to sell. Lehman's mortgage machine was still churning at full speed, but the raw material, new loans, was changing. More and more were going to borrowers on the edge of default before they'd even moved in. The early defaults. The first tremors came from the riskiest segment, subprime adjustable rate mortgages, ARMs. These were the loans with low teaser rates that reset after 2 years. The very products Lehman had eagerly packaged into securities. By late 2006, the first wave of resets hit. Payments jumped by 30%, 40%, sometimes more. Borrowers who had barely managed the teaser rates were now drowning. Default rates began to climb. At first, they ticked up slowly, from 5% to 6%, then 7%. But in the world of highly leveraged mortgage securities, even small increases spelled trouble. Inside Lehman's risk department, analysts flagged the trend. They ran models showing that if housing prices fell just 10%, certain securities could lose most of their value. But their warnings were often brushed aside. The official line was that diversification and geographic spread would protect the firm. Wall Street's denial. Lehman wasn't alone in ignoring the danger. Across Wall Street, the narrative was that housing was cooling, not collapsing. Economists on TV reassured investors that the fundamentals were strong. The phrase soft landing became a mantra. Internally, Lehman's leadership feared slowing profits more than rising defaults. The mortgage securitization business had been their crown jewel. Admitting risk now would mean admitting. They'd built the firm's recent success on a foundation of sand. Instead of pulling back, they doubled down, taking on even more mortgage exposure in hopes of squeezing out a final round of massive profits before the party ended. The hidden exposure. What the public didn't know was that Lehman had quietly begun keeping billions of dollars of mortgage securities on its own books instead of selling them. This wasn't just a little inventory. By 2007, their mortgage-related assets were over $80 billion, an enormous figure compared to their total equity. The logic was dangerous but seductive. If they couldn't sell these securities at the prices they wanted, they'd just hold them until the market improved. On paper, the assets looked profitable. In reality, they were increasingly toxic. Trouble at the source. Meanwhile, some of Lehman's biggest mortgage originators were starting to crack. In December 2006, Own It Mortgage Solutions, a major player in subprime lending, declared bankruptcy. Other firms began reporting losses or closing entirely. Each collapse meant fewer loans flowing to Lehman's securitization pipeline. Worse, the loans they did acquire were often even riskier, as desperate lenders loosened standards further to stay afloat. Early market shocks. In February 2007, the market got its first real jolt. HSBC, one of the world's largest banks, announced massive losses tied to U.S. subprime mortgages. The news rattled investors, but was still treated as an isolated problem. A month later, New Century Financial, one of the largest subprime lenders in America, filed for bankruptcy. The company had been one of Lehman's key suppliers. Suddenly, the narrative of contained risk began to fray. Behind closed doors at Lehman and in private meetings, Lehman executives debated how bad things could get. Some argued for aggressively reducing exposure. Others, including Fold, resisted, fearing that cutting back would signal weakness to the market. The decision was made to maintain the appearance of strength. Lehman continued to report strong earnings through 2007's first half, reassuring investors that they were well positioned and diversified. But inside, they were holding a time bomb got bare. Stearns sends a warning. June 2007 brought another warning shot. Two hedge funds managed by Bear Stearns collapsed after massive losses in mortgage-backed securities. The funds were leveraged heavily into the same kinds of assets Lehman was holding. The news sent shockwaves through Wall Street. For the first time, investors began to seriously question the value of complex mortgage securities. Prices for these assets started to slip, and because of Lehman's leverage, even small declines began to inflict real pain. Public confidence versus private fear. Through the summer and fall of 2007, the gap between Lehman's public statements and private reality widened. Publicly, we have no significant exposure to the riskiest subprime assets. Our risk management is best in class. We see this as a temporary market dislocation. Privately, margin calls from lenders, increasing difficulty selling mortgage securities, growing internal concern that the housing slump was not temporary. The year ends in uneasy silence. By December 2007, U.S. home prices had fallen for the first time in decades. Foreclosures were spiking. Construction projects stalled. The once booming suburbs were now dotted with abandoned half-built homes. Lehman's stock price, while still high, had begun to wobble. Investors were nervous, but not panicked. They didn't yet know that the next year would bring not just cracks in the foundation, but total structural collapse. The fractures were spreading. The weight was building. And in the high towers of Wall Street, the clock was ticking. 2008 began with ice in the air. Not just the January cold, but the creeping chill of fear. Street could feel something shifting beneath its feet. And Lehman Brothers was standing right over the fault line. January. The first hairline breaks in the armor. The year opened with a series of bad omens. The credit markets were tightening. Lenders who once handed out cheap financing to investment banks were growing cautious. Mortgage defaults were accelerating, not just in subprime, but creeping into prime borrowers. For Lehman, this was lethal. Their $80 billion exposure to real estate wasn't just subprime anymore. They'd also piled into commercial real estate, leveraged loans, and other credit products that were beginning to wobble. Their fourth quarter 2007 results, released in January, still showed a profit. But the numbers were thinner. The tone was defensive. Fold brushed off concerns, insisting that Lehman was well-positioned and diversified. Behind closed doors, his deputies knew the truth. They were sitting on assets they couldn't sell without taking massive losses. February-March. The Bear Stearns collapse. March 2008 ripped a hole in the illusion. Bear Stearns, the 85-year-old investment bank, imploded in a matter of days. Classic liquidity crisis. Rumors about bad assets led lenders to pull funding, which forced Bear to dump assets at fire sale prices, which confirmed the rumors, which led to more panic. Until it was over, Bear was sold to J.P. Morgan Chase for just $2 a share, a fraction of its peak value in a government-assisted rescue. The lesson for Lehman was terrifying. It didn't matter if your assets were good or bad. If the market lost confidence, you could be dead in a week. Investors immediately began asking, if Bear could go down, who's next? Lehman's stock starts to shake from January to April. Lehman's stock slid from the high $60s to the low $1.40 south. Short sellers, investors betting against the stock, swarmed. Hedge funds began quietly reducing exposure to Lehman. The firm tried to project confidence. Public statements about strong liquidity. Press releases highlighting unrelated profitable segments. Executives buying small amounts of Lehman. Stock to show faith. But confidence isn't something you can buy. And the smell of fear was in the air. June. The first loss in 14 years. On June 9, 2008, Lehman reported its first quarterly loss since going public in 1994, $2.80 billion. The figure was shocking, not just because of the size, but because just weeks earlier, executives had been insisting everything was under control. To raise cash, Lehman announced a $6 billion capital raise. It was meant to reassure the market. Instead, it confirmed the suspicion that they were bleeding. Investors asked, if you're only losing $2.8 billion, why do you need $6 billion? The summer of denial, July and August, were a slow-motion death spiral. The U.S. housing market continued to deteriorate. Foreclosures were now surging in middle-class neighborhoods once thought immune. Prices were falling nationwide, something that hadn't happened in generations. Lehman's mortgage securities, especially the CDOs, were becoming unsellable. Their mark-to-market values were plummeting, forcing the firm to take write-downs. Inside Lehman, executives clung to the hope of a white knight investor. They courted sovereign wealth funds from South Korea and the Middle East. Meetings were held, smiles were exchanged. But in the end, nobody wanted to be the one holding the bag. September. The week everything broke, by early September, the pressure was unbearable. Lehman's stock had fallen below $10, a 90% drop from its peak. The credit default swaps, CDS, on Lehman, essentially insurance bets on whether the firm would fail, were exploding in price. This was the market's way of screaming, Lehman is going down. On September 10th, Lehman announced a staggering $3.9 billion loss for the third quarter. Still, they insisted they could survive. Fold gave interviews blaming short sellers and rumors. But confidence was gone. Counterparties began refusing to trade with Lehman. Clearing banks demanded more collateral. The firm's liquidity, its lifeblood, was evaporating. The final weekend, Friday, September 12, 2008. Federal Reserve officials, Treasury Secretary Hank Paulson, and top Wall Street CEOs gathered in emergency meetings to save Lehman. The idea was to arrange a sale, possibly to Barclays or Bank of America, but time was short. The buyer would need government guarantees to cover Lehman's toxic assets. Paulson refused to provide them, fearing political backlash after the Bear Stearns rescue. By Sunday, the talks collapsed. Barclays couldn't get the necessary approvals to move forward. Lehman had no buyer, no government backstop, and no options. The collapse Monday, September 15, 2008. Lehman Brothers filed for bankruptcy with $613 billion in debt, the largest bankruptcy in U.S. history. On trading floors around the world, stunned silence gave way to chaos. Investors scrambled to figure out who was exposed. Credit markets froze. The Dow Jones fell over 500 points in a single day. In the days that followed, the shockwaves spread globally, triggering the worst financial crisis since the Great Depression. The aftermath, tens of thousands of Lehman employees lost their jobs. Overnight, pension funds, municipalities, and investors around the world took massive losses. The bankruptcy court battles would drag on for years, slowly untangling the wreckage. Richard Fuld, once the most feared CEO on Wall Street, was hauled before Congress, grilled about his role in the disaster. He denied wrongdoing, insisting that Lehman had been a victim of circumstances and market panic. But for millions, the name Lehman Brothers would forever be a symbol of greed, denial, and the fragility of the financial system. They built an empire on risk. They convinced themselves it could never fall, but in the end, gravity always wins. When Lehman Brothers fell, it didn't just take down a bank, it cracked open the illusion of stability that millions believed in. The collapse was not an isolated accident. It was the visible eruption of a fault line that had been forming for decades. A line where risk met greed, where innovation blurred into manipulation, and where the pursuit of profit erased the memory of past crises. The world before Lehman fell in the early 2000s. The global economy was drunk on cheap money. Interest rates were low. Credit flowed easily across borders. Wall Street's financial engineers designed products so complex that even some of their own creators struggled to explain them. Banks like Lehman were not just playing the game, they were setting the rules. They had learned to operate in the shadows, in a web of derivatives, off-balance sheet entities, and complex securities that regulators barely understood. For a time, it worked. Investors got rich. Politicians bragged about booming economies. Consumers believed housing prices would only rise. Then, in 2008, the mask slipped. The domino effect. Lehman's bankruptcy sent shockwaves far beyond Wall Street. Credit markets froze. Banks stopped lending, not just to risky borrowers, but to each other. International trade slowed. Stock markets collapsed in country after country. Within months, millions of jobs were lost worldwide. Entire industries, from construction to manufacturing, withered. Governments scrambled to inject trillions of dollars into their economies just to keep them from flatlining. The collapse revealed how interconnected the modern world had become, and how a single failure in one corner of the system could trigger a global cascade. The human cost behind the headlines and financial jargon. There was a quieter devastation. Families who had trusted in the stability of their pensions found them decimated. Homeowners lost houses they had lived in for decades. College savings evaporated in the market freefall. And inside Lehman itself, the fall was brutal. One Friday, employees left for the weekend believing they still had careers. By Monday, they were locked out of their offices, carrying their lives in cardboard boxes, walking past TV cameras that broadcast their humiliation worldwide. Could it have been stopped? In the years after the collapse, investigations, books, and documentaries dissected the question. Could Lehman have been saved? Some argue that if the U.S. government had stepped in, as it later did for AIG and others, the panic might have been contained. Others believe that rescuing Lehman would only have postponed the inevitable, leaving the same systemic risks intact. What is certain is that Lehman's leadership underestimated the speed at which confidence can vanish. They were slow to cut losses, too proud to admit weakness, and too leveraged to survive even a short-term liquidity crisis. The lessons Wall Street learned and ignored in the immediate aftermath. Governments worldwide passed regulations meant to prevent another Lehman. Banks were forced to hold more capital. Risky trading was restricted. Derivatives markets became more transparent. And yet, many of the same incentives remain. Complex financial products still thrive. Leverage, the use of borrowed money, is still a path to massive profits. The memory of 2008 has faded for many, replaced by the same old hunger for bigger returns. Real lesson may be this: systems built on confidence will always be vulnerable to fear. And in the world of high finance, fear can spread faster than any contagion. The shadows that remain Lehman Brothers no longer exists, but its shadow still lingers. It lives in every discussion about too big to fail. It lives in every political debate about bailing out banks versus letting them collapse. It lives in the quiet anxiety of investors who know that the next crisis is never a question of if, only when. For those who lived through 2008, the name Lehman is a reminder. The tallest towers fall the hardest, and when they do, they take the streets below with them. This was not just a story about a bank. It was about us. Our greed, our trust, our belief that the system is stronger than it is. Lehman Brothers fell, but the system it revealed is still here. And one day, it will be tested again. You've heard the rise. You've seen the fall. But what do you think? Was Lehman Brothers a victim of market panic, or the architect of its own destruction? And when the next financial storm comes, because it will, do you think the world is ready? Leave your thoughts in the comments. I read every single one. If you want more true stories from the shadows of power, greed, and history, subscribe. It's free, and it helps bring you more of these deep dives every week.